So on the panel today, we've got Ed John, who's the Executive Manager of Governance, Engagement and Policy at AXI. We've got Alison George, Head of Policy at Regnan. Adrian Troller, Head of Portfolio Construction and Sustainability at BT Financial Group. And Dan Gosha, who is a campaigner and analyst at Market Forces. And I'm Andrew Gray, I manage investment governance at Australian Super. Now, some of the lunchtime conversation was actually quite interesting. People have said, coming back from lunch, we need a high energy panel so we don't fall asleep, so I think that's probably true. I won't reveal who, but the CEO of one of the panellists has actually given them permission to be bolshy on this session. So that sounds very exciting. So we'll see what we can do. Now, I said there's three things that we wanted to do with this panel. First, mission accomplished. The second task was actually to make quite an exciting announcement in relation to an initiative that some of you may have heard of called the Climate Action 100+. And this is a major new climate action engagement initiative that some of you may have heard about. It was actually soft launched at the PRI in Berlin in late September, so just a couple of weeks ago. And the aim of the Climate Action 100 is to put together a sort of a targeted global engagement over 5 years, investor-led, with the world's largest emitters. And it's going to aim to curb emissions, strengthen climate-related financial disclosures, and improve governance on climate change. Now, it's interesting because the initiative introduces the concept of systemically important emitters, and it's going to focus on over 100 companies that may pose a risk to financial markets because of the magnitude of their greenhouse gas emissions or because of their exposure to climate change risks. And I guess as investors, these companies, these systemically important emitters, we clearly see as posing investment risks, either because their failure to adapt represents an investment risk in itself, or I think the other interesting concept with this initiative is the fact that they are deemed to be systemically important, the risk that their non-response implies in terms of systemic financial risk for investors. So what are we looking to achieve with this initiative? So we're pretty clear with the three objectives of the Climate Action 100+. The first one we're going to be requesting companies to take action to reduce greenhouse gas emissions, consistent with the Paris Agreement goal of keeping climate change to below 2 degrees. The second thing is we're going to seek to provide enhanced corporate disclosure in line with the TCFD and some of the other things that the global investor coalitions have been seeking. And thirdly, we want companies to have strong governance frameworks that clearly recognises and articulates the board's responsibility and to have accountability and oversight of climate change. So it builds on a lot of the work that has been done by some of the climate organisations. So we've got the Asia Investor Group on Climate Change involved, Ceres, obviously the Investor Group on Climate Change in Australia, and the Institutional Investors Group on Climate Change. PRI are also involved, so it's going to draw on some of the leadership that they've shown in this area and the ability to sort of form a good collaborative working group across the world. So logistically, the way the Climate Action 100+ is proposed to work is that there'll be a working group for each of the 4 geographic regions involved, that being Australia, Asia, US and Europe. And what that will do is they'll coordinate the local engagement activities, and then they will report back to a global steering committee which will coordinate the initiative globally. The IGCC will be coordinating the Australian working group and will be going out and seeking support and involvement from Australian investors. So I hope you, as we do, think it's an exciting initiative. I think the global nature of it, the coordinated nature across investor groups across the world, and really it being a targeted 5-year initiative where at the end of the 5 years we can actually display outcomes, I think makes it really exciting. So Emma's mentioned to me that they're holding an information session at the November meeting of IGCC. So I'd really like to encourage you all to attend that session, and that will be sort of seeking investor involvement in the initiative. So thank you. Hope that's been interesting and exciting. Certainly we're very excited to move that forward. All right, now we potentially get on to the bolshy part of the panel. I might just take my seat. I might need to relax a bit. We might just start off with some opening remarks from each of the panellists. So I might actually start, so obviously we've got an investor, ESG researcher and engagement provider, proxy advisor and engagement provider, and the activist down the end. Well, we might just start off with the investor. Adrian, can you just tell us a little bit about how you approach climate change engagement with companies?
Okay, and I think it's, thank you Andrew, and I think it's important that I give the context of the label investor. So I work in BT Financial Group. We have an internal investment team overseeing about $36 billion of assets under management. Really, we're more attuned to an asset owner structure where we outsource investment management functions to investment managers. A large amount of our assets under management come from default superannuation, but we also manage a significant amount of money for advice-driven, multi-manager, diversified portfolios. And look, the answer to the question, I'll get to engagement, but we've instigated a fairly comprehensive approach to ESG over a number of years, stemming from when we were an early adopter of PRI. In relation to ESG, we undertake ESG integration to manager selection, monitoring, our approach to active ownership and reporting. But in relation to active ownership in particular, where engagement comes in, we're focused on the primary areas of managing ESG risks and climate change risk in particular through that ongoing engagement. What do we mean by engagement? I think it's important to get that context right for the discussion we're about to have. So we mean structured and targeted dialogue with directors and management of companies, anyone from senior management through to directors, really with the aim of achieving beneficial change on risk management, governance, sustainability, disclosure. Obviously climate change is one of the key themes on which we undertake engagement. Why do we do it? I think we heard the term universal ownership a couple of times yesterday. We're not the largest team or don't have the largest assets under management by any stretch of the imagination, but certainly, in our perspective, the universal ownership concept is an important driver. But we do believe that engagement leads to changes in companies and is value accretive, can be value accretive to investors. We also believe we've obviously got some scale to achieve influence either directly or with our managers, but we also believe in the collaborative nature of engagement. And as we've seen, Climate 100 Plus, is a good initiative. You're playing right into, we hope, through participation, broad mainstream collaborative activity. How do we do it? We actually use the services of two engagement service specialists, Regnan and Hermes. Hermes cover our global equities engagement, and Regnan obviously domestically. And I guess the outcome of that engagement activity is clearly climate change is one of the key thematic priorities. We certainly see the approach as best adopted by systematic long-term structural engagement with companies on climate-related risks.
Yeah, okay, great. So Ed, if we could get your perspective, obviously you're representing a large number of investors with what you do. What's AXI's approach and what does your program look like?
Yeah, so I guess just quickly background for those in the audience who are not aware of AXI. We represent 37 large asset owners, so both Australian and global pension funds in the main. So I guess with that comes that long-term focus and really that interest in allocating capital in a way that factors in, ESG and particularly, I think, in the current climate, climate risk and opportunity within portfolios. So part of our internal governance structure is actually each year to sit down with our largest members and agree priority themes. And so it won't surprise you for the past, I don't know how many years actually, Andrew, should have compared notes, but climate has been one of those major themes. And this year, the way we've framed our climate engagement with companies is around the TCFD framework. So that was a decision taken by AXI members in November last year. And we think, again, the TCFD framework, which I'm sure has been discussed through the conference, I think is a very valuable document, talking about governance, strategy, risk management, and then getting onto the hard bit around setting metrics and targets within companies that investors can actually use. We see that as a critical frame, and we're working with 16 target companies and across a number of sectors, not just the usual suspects in the energy side, because we actually want to see more information in the hands of investors in this area. But maybe with that, I'll leave it there and return.
Great. We will return. Regnan, Alison, from your perspective, could you just give us a brief overview of your approach?
Sure, thanks, Andrew. So Regnan represents a group of investors, and they're a relatively broad church. They're quite a diverse group. Some pension funds, some other kinds of funds. It includes asset managers. If there's a unifying theme in the investors that we represent, is that they're all universal owners who recognise that ESG represents risks to their portfolio that need to be managed, and that engagement is one of the key tools that they seek to have employed on their behalf. We have an in-house team of specialist resources, people who are experts in subject matters across that very broad spectrum of ESG topics, as well as stock and financial expertise. We bring all of that together in identifying the program of stocks and issues that we want to pursue that's ratified with our clients. But while we have in-house research, we do draw a distinction between the conversations that we have that are part of that research process to inform ourselves about what the company is doing, how it's exposed to an issue, how it's responding, and our engagement program, which are very much conversations as part of a systematic program of change. And climate change is a key theme. For some of the companies that we engage with, it's the only topic that we're currently prioritising, and we'll have conversations at multiple levels across the business, often over multiple year program of seeking particular changes that we're looking for. They're set out in advance. We do that so that we're very clear in our thinking, but we really measure the success of an engagement based on whether or not the risk has been addressed, whether the gap that we identified at the start has been closed. And again, we bring our research skill sets to bear in assessing that.
Yeah, great. So Ed made an interesting comment when he said about the interest from ACSI members in climate change as an area. And one of the interesting things we do at Australian Super, we survey our members every 2 years as to what ESG issues are of most concern to them. And one of the interesting outcomes of that is that climate change by far and away is the highest ranked issues. And this is an unprompted list. We don't give them issues, we just ask them to nominate issues. Climate change is by far and away the number one issue that they nominate. In addition to that, we just inherently see it as an investment risk, as a long-term investor. But by the same token, as a practitioner, a key challenge with climate change engagement is, first of all, how can you display to your members that you're actually doing something tangible? So all this sounds great, but how tangible is it to the average member? And second of all, how can you actually measure outcomes? And that's where I bring you into the conversation, Dan, I guess to get your approach as an activist, but also your comments on what's your reaction to what you hear from us as investors?
Can I give my reaction in a minute? First of all, thanks for the quite unexpected invitation to speak today. Market Forces is an NGO, an environmental NGO. We're part of Friends of the Earth. Most of our work is around educating consumers around their exposure to fossil fuels, either in their bank, through their bank account or through their super fund. We want to accelerate the transition away from fossil fuels, and I wear that activist badge with no shame. I guess when I joined this movement about 3 years ago, the buzzword was divestment. And whenever I had conversations with many people in this room, the response was, we prefer engagement. We think we can change companies. And at that point, to be fair, to be honest, really, we didn't really understand whether or not that was true. So over the last couple of years, we've started looking at what companies have on the public record in regards to climate change. And about a year ago, we formed the view that And I know there might be some hissing in response to this, that engagement was, well, it certainly lacked transparency, as in, you know, as Andrew said, how are they communicating it to members that engagement is working and that companies are changing? Because the evidence certainly wasn't there. And I'm going to be controversial, that we actually thought it was ineffective, that it wasn't forceful enough. So about a year ago, we looked at the companies that we wanted to change, so primarily in the energy and utilities sectors, and we decided to go down the path of filing shareholder resolutions on companies where we thought change wasn't happening. We filed resolutions on Santos and Oil Search earlier this year, primarily based on the TCFD recommendations. And we have a couple of resolutions up at Origin and also one at CommBank in the second half of the year. So to go back to your original question, Andrew, what do I think? I'm probably on the fence whether it's effective or not. And I think part of our work is trying to determine which companies are willing to change. And I have a pretty good idea which ones aren't. But we can get there.
Yep.
We can talk about it further.
Okay. So I might just go back to, maybe I'll go to Adrian first, and your view as to, do activist resolutions such as what Dan does it help or hinder the engagement process?
Can I just have a
Yep.
small response
Go for
to
it.
one of the issues? Look, I think on the issue that the type of engagement that we and others undertake, and the way that we make that, or the limitations on making that publicly available, I'm talking the large-scale engagements that we have with companies, it is an issue. And how we actually bring that to life in underlying member or investor communications is something that's a challenge, I think, for us and for the industry. I have no doubt that what we do in relation to the underlying engagements is effective, and I make that judgment on full view of all of the information, the meetings that are held, the progress against objectives, and the monitoring and reporting that we get back on that. But it is a significant challenge to make that A, publicly available in a form that doesn't compromise in some respects the engagement activity that's occurring, but B, at least in a form that brings it to life. So I fully acknowledge we've got some work to do there. In terms of...
Sorry, just before we move back, actually just from Alison and Ed, just your thoughts on how do you measure success, or how do you measure your milestones as to what you're achieving with engagement?
Yeah, it's something that I started to outline in the introduction. So we do all of our analysis first. We look at the gap that we think that there is against good practice, and we set out change objectives that we're trying to pursue. But to us, it's really important that that's not the measure of success, because actually engagement in the way that we do it, in as part of a constructive stakeholder process with companies, at its best, it's a collaborative process. The company brings something to that discussion. It's not a solution that's imposed from the outside by investors. We acknowledge that we don't have all of the information and all of the answers, but we bring a lot to the discussion, and we hope that the company does too, and that answers that are owned by the business are much more likely to be robust and fit for purpose and be implemented by that business in an ongoing way. So we think about what the changes that we're seeking are, but we come back to that question on a regular basis of, given the change that we've seen, is the concern that we had in the first place addressed? And that's something that we have research methodologies to address, and something that we can talk to our clients about, why we think the subject that we were seeking to have addressed is addressed. But it is a complicated message to reduce down to a member-focused discussion, and a lot of the topics that we're dealing with are complex. Things like the TCFD. So if a company agrees to implement that over a period of time, what does a substantive approach to that look like, and why would we be satisfied or not satisfied? Start to get to be quite complex messages for a member case study, although it's something that more and more clients are trying to communicate when changes are through.
Yeah, similar process for AXI. I think being very clear on that ask and setting those key milestones. And again, it's not achieved overnight. And reflecting on our engagement on the TCFD, and I'm sure many of the boards that all of the panel have spoken to, some of those first discussions are awareness raising. Here's what the acronym actually means and why we think it's relevant to your business. We can't just be sort of writing letters or coming up with ideas that we think companies should implement without really connecting and explaining why we think it's in the interest both for long-term investors as well as the companies that need to be disclosing. And again, a lot of the discussion is around disclosure, but I think we're in that really that era where we want companies, to uphold that principle of show, don't tell. There's certainly increasing scrutiny, both public and other sort of stakeholder pressure on companies, and actually the more that they can be leading on these issues, both in their disclosure but actually management of things like climate risk, those are critically important. And again, sorry to flip back to your question, Andrew, I think, for instance, the TCFD framework has some milestones, or you can certainly distill some specific milestones that can be discussed with companies. But as Alison said, actually achieving commitment on each of those, and at each point saying, well, is this good enough? Or where do the gaps lie, is part of that challenge. And it's, again, something that's not solved overnight.
Yeah. And then just reflecting on that a bit further down, then obviously, like if we look at TCFD, in my experience, climate change conversation is a very natural conversation with a board now, and great strides compared to 5 or 10 years ago. So has engagement really not been effective? I mean, I think we've achieved a lot.
I said I was on the fence. It's worked for certain companies, and as I've discussed with some of the people on this panel, there are companies that still don't want to talk about it, and they're more than likely coal companies. But having said that, and I can do this and I know that you can't, the perfect example is South 32. We had a conversation with South 32 who told us that their this is before their sustainability report was coming out, that it would be TCFD compliant. We were quite speechless, to be honest. And I'll give you the closing remark. The closing remark was, does that mean you won't put up a resolution? So to think that it's clearly having an impact, the threat of the resolution, but there are companies, that South 32 has thermal coal in South Africa. This is a company that's prepared to change, and they may have the fortune of inheriting IP from BHP, but I can just as easily name a couple of other coal companies that aren't making that transition. So that's why I'm on the fence. It's complicated. It's probably the best answer, Andrew.
Yep. So, Adrian, going back to you and that original question. So, does the work of Dan and the shareholder resolutions from the activist, does it help or hinder what you're trying to do when you engage with companies?
I think ultimately, generally, yes, and the resolutions are not just posed by activists, I guess, would be the other comment I'd make. Shareholder resolutions are posed in a global context, not just by activists, but by investor groups that are wanting to implement change. So I think the answer is generally yes. I mean, we've clearly seen some resolutions which perhaps aren't particularly strategically thought through. So, for instance, in a global context, again, I think we have had one or two where the resolution has really been just pinning the company to change its strategy completely over a finite period of time, and in reality, those things just can't be implemented. But by and large, we have seen, activist shareholder resolutions get good support. Certainly the aiming for A resolutions on a global basis last year were significant. We had they had 98% support. The companies responded well. We had better disclosure of climate risks as a result. So I think those sort of things do point to meaningful progress in this space.
Ed, what are your thoughts?
I think, generally, obviously, it helps when the issues are aligned or the asks are similar. And again, sort of don't want to go too heavily into current examples, but I think of Ian Dunlop years back. Many of you remember Ian running for the BHP board and challenging the climate credentials. Again, he didn't receive a significant vote in favour from shareholders. There was sort of potentially holes in its strategy for the company. But what it did do, and his campaign or his work, what it did do was open a much broader discussion about climate change at BHP. And I think a lot of the investor and other stakeholder engagement around that, his candidacy, actually led to what is now pretty leading reporting in the Australian market. So it opened up that space for engagement. It's probably one of those examples where that challenge came from outside the investment community, but it was able to be used by people within the investment community and many of these funds in the room to get real change within the company. So a good example where I think those interests sort of intersected or overlapped, and there was a good opportunity there.
Alison, what are your thoughts?
Yeah, Regnan supports in principle the idea of shareholder voice through the form of resolutions. I think that they provide an opportunity to give unambiguous confirmation to a company of messages that are provided through other forms. But the value of shareholder resolutions emerging in Australia, to my mind, has been less about the way they're changing engagement with the companies and more about how it's encouraging investors to reflect on what their active ownership commitments mean, what their recognition of climate risk means. It puts all of that into a decision context, and that requires a thoughtful response. There's no neutral once a shareholder resolution has been lodged. You're asked very simply, yes or no, are you for this resolution or not? And so no matter what position you take on that, even abstaining sends a message, at least to the company and very likely to other interested observers. And so there is a risk that a weak vote can send an unhelpful message that can undermine engagement. And I think that that's something that requires really thoughtful consideration and looking favourably on resolutions that are well cast, whoever designs them, if they align to shareholder priorities that we've been agreeing throughout this conference are not being addressed as quickly as we'd like them to be, that there's an opportunity to send a message that's consistent with the other activities that investors are undertaking.
Yeah, great.
Sorry, Andrew, can I just add one thing? I'd also like to call out sort of outside shareholder resolutions. I think the role of NGOs and other stakeholder groups can be useful for investors. We're not experts in certain parts of human rights or labour supply chains or other factors, and climate is in that basket. So where we can actually get information from those groups, connect, engage, learn more about the sort of issues they're facing, it actually helps our engagement. So again, the more information available to raise those issues, to have evidence to back our engagement, the better. So that sort of goes for the NGO community more broadly.
Yeah, from my own perspective as someone who votes, I find them typically, the existence of them, to be typically very effective in promoting engagement with companies. The credible threat that something is going to be put to a poll with shareholders creates a degree of tangibility that really focuses the discussion with the company, and often it puts a time frame. There's going to be an answer on how investors feel about this issue on X date, i.e. the voting date. So we find them useful. I think your point is interesting, Ed. We think the same. So, working generally with NGO groups can be useful. I think it's interesting that the climate change NGOs tend to be more adversarial than those in other areas. And we've certainly had constructive relationships with those in other areas. But there's different, yep.
Can I just mention just on the limitations of if a resolution or the threat of a resolution doesn't exist? Our view as an NGO is that, where's the stick? If a company isn't, prepared to improve its disclosure, for instance, or commit to TCFD, how do you punish them in a way? Well, it's a poor choice of word, perhaps.
We might not be trying to punish them, Dan.
No, it's disclosure is a relatively low bar, and if they're not prepared to improve it, do you vote against directors? Do you vote against REM? That's pretty crude.
Does anyone want to make a comment on that? Yeah. I mean, but from my perspective, ultimately, it's a director vote. Ultimately, that's like our fundamental right and responsibility to get the right directors on the company, and for the company to be managing all the issues well, including climate change, which is vitally important. So that's ultimately where it would flow through.
Yeah. Let's be a bit more controversial. We're all agreeing a little bit too much. I think that there is a danger in shareholder resolutions being considered an alternative to engagement instead of to drive through changes that can't be achieved through a constructive channel. In the United States, we often look to that jurisdiction when it comes to shareholder resolutions. Resolutions are largely used there to open the door to engagement. It's because the culture of investor-company dialogue doesn't exist there, and that we don't want to put that constructive relationship that we have with companies in danger. If there's something that we can learn from the Australian climate change policy debate, is that it's unhelpful when we have a polarised discussion, when we no longer have any middle ground, and that it's important that the claims are reasonable, that the timeframes are reasonable, that they're adequately explained, that it's pursued through as constructive a process as possible.
And it's partly that question of which tools in the toolkit. And I mean, another interesting example offshore, I mean, we've already talked about the Aiming for A coalition. That coalition basically formed because there are a small number of global oil and gas companies that large investors, and particularly pension funds and others, had been engaging with, that just would not budge on climate disclosure. So again, the coalition formed for that purpose, and they co-filed resolutions, and AXI members are among those that sponsored them and supported them, and you actually had companies turn around and, the boards started backing them and recommending a vote in favour. So interesting to see whether that sort of develops in this market.
Now back to you, Dan. So, as investors, we think we do engagement pretty well, very well thought out. Part of a broader sort of investment strategy. So very focused on what we think is going to generate the best outcomes for our members, which is what we're here to do. So I'm interested then to hear from you. What is your process for identifying which companies you're going to put a resolution up, and what is the engagement history, if any, that you would have with a company prior to doing that?
Okay, so as I mentioned in the beginning, we really only began this work in earnest probably a year or 18 months ago. I guess we'd had sporadic meetings with companies in relation to specific fossil fuel projects. But now that we have runs on the board, so to speak, and we've begun that constructive engagement, that I imagine that we would continue to have those conversations over time, as you do. Our primary focus at the moment is on energy and utilities companies, and more recently large energy users. Think the likes of BlueScope, Boral, etc. But look, I'm part of an environmental movement. There are other NGOs out there that have seen this work and are encouraged by it. So there's no reason that couldn't evolve over time. And I know there's NGOs agitating to look at whether it's deforestation or plastics or it's a perfect opportunity actually to mention the work of ACCR and their work on human rights. So there are other NGOs out there. We're primarily focused on fossil fuels and fossil fuel use, but that can evolve over time.
And so I guess this is a question for all the panel. I mean, obviously the shareholder resolutions are typically focused on disclosure. So is this useful? Is this the right thing? What else could we be asking for? So
maybe just to briefly come in, I think one reason that resolutions are focused on disclosure is actually the clunky regulatory regime. Yeah. So that's a reason why some resolutions are cast as they are, and there's questions about what's in management's control, what a meeting can ask for. And just a quick, I guess, plug in a way, AXI is actually doing some research in this area. And for the funds in the room that are voting this AGM season, you will have seen constitutional amendments at each company that has been targeted. Again, we think the Australian system is clunky, and it sometimes prevents investors actually supporting resolutions where they're asked to change a constitution. So we think there's an open debate, and we'll be publishing research soon looking at alternatives in the US and UK where there are sort of better mechanisms. So just wanted to throw that out there, and I think that's the part of the reason why resolutions are very disclosure focused. But again, any funds in the room interested in the issue would be happy to connect after this.
I'd say that disclosure is never just disclosure. You know, when you call for disclosure, you're calling for the company to have the processes in place to be able to disclose. It's a trick, really, I guess, to ask for something so reasonable as disclosure, because it requires companies to get their house in order before they can. And I think that the TCFD recommendations that we've talked about quite a bit already, there's very clearly two parts to the expectations there. One is that you're going to be transparent and to talk to the world about your approach. But the other is that you do analysis about how resilient your business strategy is under a range of different scenarios, and that's very substantive work that has to go on within the business, and the benefit is from having both of those things in place. And so I think that it's interesting to see whether or not investors are going to robustly rally around the TCFD disclosures, because most of the people in the room would understand the kind of process that's been gone through. They've only recently been finalised, but it's a long process that's been gone through up till now. It's the Financial Stability Board, it's a high-powered task force, it's a multi-stakeholder process, it's purely focused on risk and opportunity. It's a framework that's been designed for us. And I know that the initiative that you're launching today includes support for and calling for companies to do TCFD disclosure.
Yeah.
And I think that it would be nice to see investors calling for and acting consistently throughout that every time that they have the opportunity to reinforce the message of the value of that work, even if it is disclosure.
Yes. So just by the way, the Climate Action 100 Plus does call for disclosures consistent with TCFD. Adrian, what are your thoughts on?
Oh, look, I haven't got a lot to add to those comments. I mean, I think obviously the disclosure focus has been obvious, but has been useful.
Yeah.
Requesting disclosure of portfolio resilience to low carbon scenarios, etc., is useful information. I think my only comment with all of this is, as investors, are we getting the right information to ultimately make, financial investment decisions from all of this additional disclosure that's being requested? I mean, that is a huge and open-ended question, and I think given the relative infancy of the types of disclosure, the types of data, we're still at the start of that whole journey. But personally, I think it's good to keep the request for disclosure, relevant in that context of how is this information going to be used and what is its relevancy to investment decision making, which is what's underpinning all of this at the end of the day. The only additional thing I'd say to, I think we've got an example of this in the Australian context is, resolutions around types of resolutions that we might see in future around ensuring a company is, got consistency across its public policy statements and its actual activities and alignment there. I mean, there's many ways of doing that. I don't think resolutions are the only way of achieving transparency on that, but I think it's just another pointer to an evolution of where resolutions are heading.
Yep. So obviously as investors, we're pretty good at asking for things. So reflecting on TCFD and the applicability to us, and I'll start with you, Adrian, as an investor. Does TCFD apply to you, and what are your plans? What are BT's plans?
Yep, we're certainly supportive of the framework. I mean, it would be hypocritical as an investor to step away from our obligations to, take the information that we're requesting from companies and not use that in our investment process and additionally in our reporting processes. So I think definitely supportive. I think that there is definitely some challenges around us doing that in our, and I'm talking specifically about the reporting and making sure that this information is implemented into investment decisions. That's not an easy thing to solve and have an immediate solution. But certainly, things like scenario analysis and stress testing on portfolios are useful things for our members to see, and also for us in portfolio construction. I think the reality is, again, from an investment management perspective, our industry is at a very early point in trying to make this or feed this information into investment decision making. And I've seen a lot of stress tests on matters, unrelated to climate or ESG, and the discussions that happen with those stress tests can not be particularly informative, or actually impact portfolio construction or investment strategy. So I think this is an additional challenge on the traditional ways that investment managers look at stress testing. But I think it's definitely in the right direction. In terms of our own disclosure, we commenced last year with a very basic measure of what I sort of can only really classify as a value at risk from highly emission intensive companies and sectors in the index and within our own portfolios. And that was definitely along the lines of what the TCFD framework is designing to achieve for asset owners. But again, it's a fairly blunt instrument in A, analysing risk, and B, actually disclosing to members. But in the context, this is something, and it's far better placed now with the framework and something consistent across the investment community than we were 12 months ago.
And Ed, I suspect you might have 39 or whatever the number is, AXI members beating down your door to get you to help them with their TCFD.
Sure,
yeah. So,
I guess, on a couple of levels, one thing, and I recognise the work done by the IGCC on fund disclosure and some of that work. We do work internally, and again, that's increasing, I think, within AXI, trying to help our members in this area. And my own personal view is it's a missed opportunity. So if your fund is, working hard to integrate climate risk into your portfolio, actually telling that story to the end member, has to be a key piece of the puzzle. Sure, it's not the only one, but if the TCFD is used to do that, and certainly there are other mechanisms, again, I think it's a missed opportunity if funds don't do it. Because from the outside looking in, there's not a huge amount of information about how climate and carbon is factored into investment decision making. But personal view.
Yep, no, fair enough. And Alison, any quick thoughts?
Well, I think that we might all, investors, start looking forward to resolutions from Dan for investors as well in very short shift for those of them that are exposed to that. So I think that the reality is that there are expectations on investors in the way that there are on companies, and that means that there's a need to embrace that opportunity to respond.
Yeah. From Australian Super's point of view, absolutely, we think it's something we need to report on. Our members ask us for it already. TCFD, we think, is a good framework. I think your comment before, Alison, about it'll be interesting to see how much investors kind of latch onto this. My feeling is that it has actually developed a lot of momentum very quickly, because I think on one hand, people are really relieved, okay, we've now actually got a framework, but on the other hand, pretty terrified, how do we actually do it? So I think that's the status of where it's at. Now, we're probably running quite short on time. So, we'll get some questions. Okay, so hands up. Okay, we've got one over here.
Hi, Julian Polser, formerly of AODP. Piece of news. First of all the large investors have already reported TCFD because the Asset Owners Disclosure Project got a heads up from the FSB task force of what the structure was going to be. And that's what came out in the January 2017 framework. So it's a good basis on which the investors can take to the companies. Secondly, divestment's kind of failing already, so engagement is winning. By their own estimates, they've got 5 trillion divested under management, and even that's not really divested, of course. And that's, what, 5% of 100 trillion in the market, so by their own admission, it's going to take 100 years to fully divest. So I think engagement is the way to go. And also, how do you put in a resolution against somebody like AGL anyway, who's at war with the government? I guess a couple of things. One is a question to Ed, because the work that AXI is doing on constitutional change is absolutely critical. A bit of global context, in the US, you've got advisory resolutions, and that's what creates the culture that allows relatively small SRI-based funds to drive the larger funds to support resolutions. But it's worth remembering, Alison, that some of those companies in the US do not talk to their shareholders. So you're lucky here that the companies do have an open door to the owners, but I think the rest of the world is just looking for, in Bob Monks's own words, for owners to become stronger owners, and that really means the asset owners sort of taking control and looking to raise resolutions at scale in order to get the change that everybody needs. And you know, a critical part is giving you access, even though, of course, you're right, Andrew, it's the boards ultimately who take responsibility, and that's what the whole proxy access thing is about. But again, proxy access could take 15 years before somebody can replace a director on every one of the fossil fuel companies. So a lot of things in place, some regulatory, but also culturally, we've got to start raising resolutions at scale if we want to see the sort of change that we've already all been talking about in the last couple of days.
Maybe just to, I guess, offer a view. I think it's an interesting time, particularly with the TCFD, and when we think about our Australian portfolios, there are 2 companies, arguably 3, that have talked about scenario planning within their portfolio of assets. So there's a huge amount of work to be done on actually information and the adoption of the TCFD, a whole range of steps. The interesting part for me is fast forward sort of 12 or 18 months or 2 years when, us on the panel, many of you in the audience have been engaging with these companies to get adoption of things like the TCFD. How do we deal with the immovable objects, or those that still say no after that point? I think, again, the shareholder resolution, like aiming for ACO, could be a next step if if there are some of those recalcitrants that just will never move.
We've got time for a couple more questions, or?
Hi, Nina James from Investor Property Group again, sorry. As the person who's going to have to do the TCFD reporting and set up the framework, I would also like to support the engagement, efforts, because every time investors ask my fund managers questions about anything to do with climate change, it comes directly to me, and that gives me a mandate to push a little harder and go a little further. So I'd like to encourage you all to engage with your investment products, because you actually, although it's a really painful experience that I have to fill in 25 different surveys, it also helps me get my projects across the line. So I'd really like to endorse engagement and hopefully never have to deal with shareholder meeting situations. Moving forward from that, I would like to understand your expectations of timeframes. So we are madly trying to understand what the TCFD will mean for our disclosure, and we're very proud about our level of disclosure. But I want to understand, how much time are you giving me? Like, what's my deadline here? When do you expect to start seeing investment products articulating TCFD recommendations in their reporting? So timeframes.
I hate this phrase, but as soon as practically possible. I put practically in there. I didn't say as soon as possible. But seriously, I mean, other than clearly the obligation of the workload, etc., that needs to be managed, we need companies, and I'm also talking about ourselves, to get on and start to implement this framework. I mean, there's a lot of time and effort invested in it, and it's structured by investors, by companies, by institutions within the investment community. And clearly, I think it's now time to get on to the hard work of implementation. What the time frame is, we'll just need to get on and do it within what resources you can allocate to it, but the expectation is there to get on with it.
Perhaps to just share one, I guess, data point from our company analysis. Again, investors aren't people expecting all companies to go from 0 to 100. So if you think about the TCFD framework, for instance, there are disclosures that can be made on the governance, strategic oversight, some of the risk processes, which may start at the policy level. Again, the hardest part is metrics and things like scenario planning. But if we can get some companies from 0 to covering the first 3 in the next 12 or 18 months, that's a good start. That opens up a board dialogue, a management dialogue, and then you can have the conversation about what the right metrics or the next level disclosures are. So again, tailored to each company. I think that starting with some of those governance and strategy processes and then moving on to the hard stuff.
Now I can see we've got one question. We've got how much more time, Crystal? Do you? Yeah. One more question. So we've got time for one more. I think you've got the microphone there, so we'll go with that.
Okay, I'll make my question very quick, which is it would be great to get your thoughts about the role of index investment and engagement. And the reason why I ask that is in the context of where I'm based in Japan, where a lot of the asset owners are index based, and yet they've got the stewardship responsibility and engagement. So if you could comment on that, please.
I'm happy to have a go at that one. I mean, one of the reasons why we undertake the engagement we do is for the very reason that some investment managers, some strategies are just not going to engage with underlying companies, passive being the ultimate example. We're clearly seeing some of the big passive managers differentiate in a space which is difficult to differentiate in terms of passive implementation on the basis of their engagement activities. BlackRock is certainly, and Larry is ramping up his messaging around his expectations of underlying companies, in the framing of index providers being, the ultimate long-term universal holders of all companies in the index. So that's positive. It'll be interesting to see how far they're able to actually progress that.
Okay, well, I think we're out of time, so thank you for a great session panel. So there's two things I'd like the audience to consider, please. First of all, the Global or the Climate Action 100 Plus. So we think it's like the next chapter in really targeted climate change engagement. So if people could please consider supporting that by becoming a signatory. And the second thing, I'd like you to thank our panel today. Thank you.